Okay, great topic. So Emily, all the way from Perpetual Private Wealth, talk a little bit about dealing with not-for-profit clients in this fantastic world. It's a complete new market, which I wasn't even really fully aware of yesterday, but thanks for taking us through it. So share your thoughts today, please. Welcome, Emily.
So today I'll be running through how to advise not-for-profit investors, and in particular how they compare to your more traditional retail clients and what those key differences are, how that impacts the advice that they need, and how to successfully win and onboard a not-for-profit client. So how do not-for-profit investors compare with your families, couples, or individuals? So firstly, as mentioned, those families, couples, individuals are typically retail clients, not all of them, but typically, whereas your not-for-profits, on the whole, are wholesale investors. Whilst fairly obvious, this is really important when it comes to the advice because the governance requirements and expectations are quite different, and the advice that you've given to your retail clients isn't necessarily going to be applicable in the same way to not-for-profits and vice versa. Not-for-profits in particular tend to be a lot more investment focused and looking at those investment solutions as perhaps some of your more traditional retail clients. Next, whilst their circumstances will change through time, with your retail investors, typically you're dealing with the same people, so you build those relationships, you get to know them, and whilst of course their circumstances will change through time, those strong relationships will help make that advice process easier. Whereas your not-for-profits, yes, you'll get to know the organization and their mission and values. However, the people that you deal with on a day-to-day basis will change through time, to the point where it's a long-standing client that actually you're most likely to have the history of that client versus the people that you're actually giving the advice to. Next, for not-for-profits, the key decision makers do not own the assets that they're making those decisions on. And what that tends to mean is they become more conservative because they're trying to protect those hard-earned assets from the donations that they've been given. But you've got these investors that are often in perpetuity investors, so actually their time horizon means that their risk tolerance or risk capacity can be quite high. So getting that balance right between risk capacity and risk tolerance can be a bit of a challenge with these clients. They also have their own stakeholders that they need to consider, so their donors and their views on investments. They'll often be monitoring performance, or not often, but sometimes they'll be monitoring performance as well as actually the assets that they're invested in. So responsible investing does become particularly important for this sector, and I'll go into that in a little bit more detail in a little bit. And finally, tax status. So this is actually more straightforward for not-for-profits because generally they are tax exempt and that does not change through time. So from that perspective, the investment strategy does not need to change through time. So moving on to the advice process. With your retail clients, you'll undertake a fact find, you'll establish a risk profile, and as part of that process, you'll discover whether or not there are any other considerations that will impact the advice that you give that client. Whereas with a not-for-profit, there is no fact find, there is no risk profiling, at least not in the same way, and there is also no statement of advice. You need to understand the cash flows of that investor so you can understand the income needs, and that really is the key starting point for those clients. That gives you the idea for the risk capacity, and then you'll need to work through the investment committee or board to establish whether or not there are any other investment considerations that are going to impact that advice. And that will overlap to some extent with your retail clients, but they may be a little bit more specific or a little bit more technical. In particular, with responsible investment and how they want that reflected in their strategy. And this can be challenging because responsible investing is a spectrum and you've got a range of stakeholders that you all need to get aligned in terms of how you're going to implement that. And typically, these boards and investment committees will have a range of experience within both investments and responsible investing. So getting them to a point where they agree, can be a challenge. Again, like retail investors, they may have specific requirements around fees, liquidity, credit quality. They may have asset classes that they don't want to invest in, and views on active and passive management. That will drive your investment policy statement and implementation. And then you've got your regular reviews and reporting. Your not-for-profits will have, as I mentioned, a range of sophistication, and that will mean that you do need to tailor your advice and your conversations to those different audiences, and often you have to do that all within a single meeting. And for those sophisticated investors, that detailed investment analysis attribution is going to be important. So before I go into some of the components of the IPS and what should go into it, it is worth noting what it is and why it's important. The IPS is the document that serves as a strategic guide for you as the advisor to ensure that you invest the assets in an appropriate way and that isn't deviated from. The IPS will also include those important implementation factors, such as the not-for-profit's views on ESG, appropriate investment structures, as well as any other restrictions. And it's important because it provides alignment, ensuring that the portfolio is constructed to meet the needs of the organization. It provides continuity, so that consistency as you get changes through board and organizational changes. It's good corporate governance, so it evidences that robust and considered investment decision framework. It will define the philosophy and portfolio objectives, and that helps provide a framework to assess the portfolio through time for those investment committees and boards. And it provides focus, so particularly useful during periods of market volatility to make sure that long-term objective isn't deviated from, promoting better longer-term outcomes. And finally, independence. So it allows those investment committee members and boards to delegate key decision-making to either key parts of the organization, but also to the investment advisor. So as I previously mentioned, for a not-for-profit, that first step is really about understanding the cash flows of the organization. This will drive whether you need to split funds into multiple buckets and will give you an indication of the time horizon and risk capacity of that organization. And some of the key questions that you might ask as part of this process are listed on the slide, and that includes what are their essential and non-essential income requirements. Do they have any planned capital expenditure in the short to medium term? And how much of this will need to come from their investments? So do they have any other sources of income? What is the tolerance for variability in that income? And do they have any known inflows? So if they do require regular income from their portfolio, which is often the case, you should then have the information you need to develop a spending policy, and this spending policy forms part of this investment policy statement. And what that will do is it will dictate how income is derived from the portfolio. It will define the calculation, which dictates how much is distributed. It provides alignment between the different objectives of the portfolio, and will help control that balance between the shorter term and longer term spending requirements, helping to maintain the real value of that portfolio if it is an in perpetuity fund. As you can see from the diagram at the top of the slide, you'll also need to establish how much money and how that money flows between any different pools that you have for that client. It might be as simple as just having that longer term pool with an income that distributes annually into a shorter term pool or cash account. However, you may need a slightly more complex structure if that not-for-profit has different income needs and time horizons that they need to plan for. So, for example, you might set up that long-term pool with that long-term 10-year plus time horizon that does still pay income into a shorter-term pool or cash account, and occasionally top up a medium-term pool, which will be there for those larger capital expenditures over that sort of 3 to 5 year time horizon. And that might be for a renovation or perhaps a property purchase. Over that sort of 3 to 5 year time horizon. And as that expenditure gets closer and more certain, you can move that money into that shorter term cash account. So all of that pre-work gets you to the time horizon and the spending policy, which gives you also the number of pools that you're going to need for that particular client and the risk capacity. However, that risk capacity is likely to be different from the risk tolerance of any particular organization. And because there is a spectrum in terms of investment sophistication, the next stage will vary, but essentially you need to stress test different potential outcomes with the client to get to the point where you can land on that suitable portfolio that's going to deliver the income needs that the organization needs, whilst taking a level of risk that the investment committee and board feel comfortable with. And this is important because investment returns for not-for-profits are often a really important source of untied income. So often when they'll get donations, it'll be for a particular project or for a particular cause. And it can be harder for them to source funding for day-to-day operations. And so often their investments are core to that running of the day-to-day business. So tactics that you might include is starting with a lower risk portfolio with the plan to increase risk through time. This can be particularly useful where your investor is starting from a point of cash and investing for the first time. You might show them different expected returns and risks of different portfolios, what might happen through different scenarios, sort of stress testing those outcomes. And then otherwise, case studies of what other not-for-profits have been doing and why can be really helpful to get them feel comfortable that the risk profile is going to be suitable for their particular needs. From these discussions, you should land on that achievable risk and return objective. So the next topic to discuss is liquidity for the portfolio or portfolios, and this should be a fairly straightforward discussion by the time you get to this stage. The focus really needs to be around that level of flexibility they need within their portfolio and whether or not there may be unforeseen spending requirements and the sort of size that they might be. And that will dictate whether or not you can invest in those less liquid investments. And particularly for your endowment in perpetuity type investments, they do have a fairly low liquidity requirement and so can actually have quite a high allocation to those more alternative asset classes, which is beneficial for these investors because they can produce a more stable income to help them fund those operations through time. Fee constraints will also play into this, but very much those net of fee returns and net of free income flows are going to be what's important or should be what's important. And then all of this gets documented within the IPS and will dictate your strategic asset allocation for each of the pools for those clients. So I would note that whilst it is important to be able to tailor strategic asset allocations because not-for-profits don't always follow standard models and do require some tailoring in order to accommodate those different objectives, managed accounts can still be a great solution for this sector. Many will still fit the standard models, and where they don't, you can always utilize a provider that is going to be able to tailor some SAAs for you and this client base. Or you can utilize asset class managed accounts, which are less common, but do give you more flexibility when it comes to the strategic asset allocation. However, you then may lose some of those governance and efficiency benefits that come with those managed accounts. I would note that changing your investment strategy, particularly at the asset class level, shouldn't happen frequently because your best investment ideas shouldn't change. The main exceptions to that is where the client has ESG views that make those, or make your best ideas unsuitable for whatever reason. Or perhaps if they have very strong views around fees or tracking error considerations. However, of course, even if you are choosing to outsource those certain investment decision making. As the advisor, you're still very much responsible for that decision and will be very much held accountable for those decisions. And so being able to find a provider that is going to be able to give you that detailed reporting so you can really understand what's happening within that portfolios is going to be particularly valuable, particularly where these more sophisticated investors are going to really want to drill down into the detail. So next stop is responsible investment. And as I mentioned earlier, it can be a challenge for this type of client because many will want to do something, but they won't know what or the implications of those decisions. And it's likely that different board members and different investment committee members will have different views when it comes to this. On top of this, not-for-profits have their own stakeholders, which will have views on what the organization should and shouldn't invest in, that they will also need to manage. And this is one of the reasons why it's so important for not-for-profits to clearly document what their responsible investment beliefs are and how that impacts their investment decision making. Because by not doing so, there could be serious implications around their brand and potentially future donations. However, if there is a clearly articulated and understood ESG policy in place, the board will be able to explain why any holding exists within that portfolio and why they feel comfortable with that particular holding. A good ESG policy can also be used to help attract new donors, particularly when it comes to those long-term investments and those sort of more endowment foundation type structures. From a policy and implementation approach, this discussion is important because, as we've discussed, it is not black and white, and responsible investing does cover a spectrum, which is outlined on this slide. You have conventional investing to the left, which is that limited or no regard for ESG practices. This is actually less common these days because certainly when you're looking at managed funds, there will be some consideration for either environment, social, or governance factors, but this will typically be limited. ESG investing is becoming the standard, and it's where managers are looking to enhance long-term returns for their investors by using ESG factors to manage risks and to look for opportunities. It's important to note that these types of strategies will not have long lists of exclusions, potentially no exclusions at all, and will often invest in companies that do generate revenue from your likes of fossil fuels, alcohol, gambling, armaments, etc. They're also not looking to have an impact per se. So they're just looking to make good investment decisions, noting that climate change and how governments look to manage that, as an example, is going to impact different companies differently through time. Impact investing is the next level along and is going to be of interest to a lot of your not-for-profit investors. And this is also defined differently by different people. So you are at risk here of managers investing in a way that is different to you or your clients' expectations. Because these strategies should be looking to have a measurable environmental or social outcome, they often will have a significantly reduced investment universe. And they'll use both positive and negative screens when it comes to defining what they can and can't invest in. And that is important to bear in mind because these strategies will have higher tracking area to your more traditional benchmarks. But as discussed in the last session, that doesn't necessarily mean they're going to underperform through time. There are just going to be segments where they are likely to significantly deviate from your more traditional benchmarks. However, increasingly we're seeing managers focus on engagement and using their influence with companies in order to show that they're delivering better outcomes for their investors. And these funds typically will have a broader investment universe and may invest in some of those stocks that you're not used to seeing in an ESG type investment like your, say, fossil fuel companies. And the justification for that approach is that these companies exist regardless of whether responsible investors invest in them or not. And actually, it's better to have an investor that's going to be engaged and want to have that conversation with management to try and improve outcomes and therefore sort of improve that global sustainability. Finally, on the right-hand side, you have your philanthropy, which is typically more social outcomes driven. And rather than, focus on returns, they may generate some returns, but this will not be the focus of these strategies. And for that reason, aren't likely to be of interest to most of your investors. Certainly not-for-profits would also fit within that. However, from a income perspective, philanthropists can be a really important source. So it is important to these types of client from that perspective. So what does this mean from a policy and framework perspective? And so when it comes to developing a robust policy, a very good starting point is the values and beliefs of the particular organization, rather than sort of focusing too much of the individual views of the investment committee or board. Exclusions will likely form part of the strategy for these clients, but you should look to educate and encourage your clients to work more broadly with the sectors that they don't have such strong views on. And from that perspective, that ESG integration and active ownership can be better to ensure that the portfolio is still invested responsibly, but it's large enough the investment universe is large enough to achieve that better diversification than you're going to be able to achieve through a pure impact-only type strategy. So the last topic that we need to get clarity on prior to drafting a new IPS or reviewing an existing IPS is the ongoing governance. So that's the who's responsible for what. Other than being a fiduciary responsibility of a not-for-profit board, getting clarity on who does what is important for a number of reasons. But a key one is that timely decision-making. Boards will only meet at certain frequencies typically, and often you do need decisions to be made in between those times. And that can help not only manage risk, but also generate additional returns for those types of investors. So just on this slide are 3 common structures. There's always a board that always has ultimate responsibility for the portfolio, but they may delegate a number of investment decisions to an investment committee, or they might call it a finance, audit and risk committee. They may also have other names for this committee. And in turn, that committee may delegate certain decisions to a delegated person or straight on to an investment advisor for that day-to-day management. And as the advisor, you'll be responsible for delivering a strategy in line with the IPS, ensuring any managers that you have selected on behalf of that client also are investing in line with that IPS, and then reporting on that portfolio in line with the objectives outlined in that document. So once you've been through that process, you should have everything you need to document that IPS, and once that's been approved by the board, you can make those investment recommendations on the implementation. So this would be the first point, once the IPS has been documented, that you would actually start talking about managers and funds and strategies. This should be fairly straightforward if your IPS has been clearly documented, because it will provide a very clear structure as to exactly what you can and can't invest in. You then go on to implementing and ongoing reporting. And as mentioned a number of times, reporting is particularly important for these clients because they don't want to just know the numbers, they want to understand why and what's been driving returns, and how you and the managers or the assets within that portfolio have been adding or detracting from those returns. So attribution is really helpful, how they compare to the broader market, so peer universe is helpful, as well as those standard sort of versus objective type benchmarks. So finally, to wrap up, governance and initial setup is absolutely critical for success in the not-for-profit sector, and how you evidence and explain this process can be key between winning and not winning a new not-for-profit client. And once you've done all the hard work in getting a client properly set up, the ongoing advice should be fairly straightforward, as the IPS will be your framework in order to implement the strategy for that particular client. Of course, the IPS does need reviewing on a fairly regular basis, but it should be flexible enough for you to be able to make the decisions that you need in order to deliver good outcomes for that charity. And yeah, I guess from that last point is that tailored approach. So being able to not only deliver perhaps a tailored strategic asset allocation to these clients, but be able to have those more complex investment discussions. And then those value-added services are going to be particularly of value, and they're going to be different to your retail clients. So, it's not just about investment advice. They want to know what else you can help them with. And in the not-for-profit sector, it's more likely to be around that fundraising and fundraising strategy that is going to be important and really helpful for them. And they're going to really value that type of additional service if you are able to offer it. With that, I'd like to thank you for listening, and I think we have some time for questions if anyone has any questions. Yeah.
Thank you for that. If you're tendering for an NFP, and apart from the standard due diligence of their investment process, their goals, timeframes, everything else, what other due diligence would you take in terms of that NFP? Like, for example, looking at board papers, financial statements, and so on.
So the main one I would is get a copy of their IPS if they've got it, and understand all the documentations, the restrictions, and then actually tailoring your response to that IPS rather than going sort of through any standard answers, like really understanding what their policy is. Certainly going through their website, understanding their missions, their values, what actually is important to them, is good background work before you go into that process.
Other questions for...
Can you outline what the timeframes are around the process for governance and setup? And I appreciate that all clients are different, but how long do you generally see that taking?
Yeah, so absolutely. It tends to be driven by how often the board meets and whether or not they're willing to have sort of ad hoc meetings in order to get it there. But often, actually, you can get through a lot of this process. So you'll need an investment committee to be able to brainstorm or workshop a lot of this. So you have to have that meeting. And then you should be able to get most of the work done from that meeting to whenever the next meeting is. So often it'll be a couple of months. So you can do it within a few weeks if they're willing to really push through it. But typically it will be a couple of months between meetings because, these investment committee and board members all have day jobs, and you'll have to sort of fit around their cadence of their meetings.
I've got a question about the involvement of the advisor in particularly government-sourced grants. I mean, grants and government funding, NDIS and so on and so forth is an increasingly important part of the revenue source or for not-for-profits. I mean, what do you think an advisor should, or how involved do you think they should expect to be in that sort of formal grant-seeking, government-sourced funding process?
So I think, and where we would get involved particularly is around more that strategic planning for the fundraising. So rather than, doing it for them or helping them through that process, it might be about being across the sector, what's happening, what are the trends. And one of the key trends now, as everyone I'm sure will have seen in the news, is actually governments cutting funding to a lot of not-for-profits. So a lot of the conversations we're having is, well, how do you diversify your income? You might have been well funded by a government before. If it's not being cut completely, it's likely to be cut a little bit. And so have you got processes or plans in place to be able to source income from other places? And if not, have you got a process in place, or are you able to reduce the income that you spend, and how are you going to do that?
Thanks, Emily. At the point that a portfolio changes for one of your not-for-profit clients and you've got to put forward a recommendation for a change, what sort of validation or supporting documentation are you providing around that portfolio change?
Yeah, so typically would find, so it depends if it's a manager change or a strategic asset allocation change. If it was a strategic asset allocation change, would normally provide a couple of example portfolios, the expected return of that new portfolio just purely from an asset class perspective, just strip out any of the implementation decision making, what the expected drawdown is of that portfolio, like what a GFC type event might look like for that new portfolio, like what are those real sort of 1 in 20 year events going to look like? Because that's when you don't want any client to be making a change, is when you've sort of had a big drawdown from a portfolio. And yeah, just some of those more nuanced risk and return statistics. And then when it comes to manager change, it will just be more details on the strategy. So where does this manager sit within the portfolio? Why does it complement the existing managers? So I'll often talk about factor exposures, the factor exposures that you have within the existing portfolio, and then why this new manager really complements that. Because you're not looking for managers that outperform all the time. You want them to be performing differently through different points of the cycle, so you're really smoothing that journey. So it's really about the purpose that it plays in the portfolio and why it blends well with the existing managers that they have.
Okay, thank you, Emily. Hand together for Emily. I want to